All right, Mike, I think we're ready to get things started here. Welcome, everyone, to today's webinar. We appreciate you taking the time out of your day to join us. You won't be disappointed with Michael's insights. A couple housekeeping items before we get started. Everyone's camera is turned off and your microphones are muted intentionally. We will have Q&A at the end of Michael's presentation. You can use the chat box at the bottom of your screen to ask your questions, or you can email them directly to me at john@reddoorwealth.com. I will aggregate those questions and direct them to Michael at the end. Also note that this is being recorded and can be sent out after the Zoom is over if you missed something. This webinar is being hosted in late April 2021 for those of you who are watching the recording. With that, I'm excited to introduce our speaker today. Michael Townsend is Charles Schwab's Vice President for Legislative and Regulatory Affairs. What that means is that he is Schwab's Washington insider. He spends his time figuring out how policy and political developments in Washington affect the markets and individual investors, and then communicating that perspective to lawmakers, the media, investors, and investment advisors. Mike started his career as an aide to 2 U.S. senators and has more than 28 years of experience in Washington overall, including the last 21 at Schwab. Mike is also the host of Schwab's popular podcast, Washington Wise Investor. He is a graduate of Bowdoin College in Maine and holds a master's from George Mason University in Virginia. So with that, I'll turn it over to Michael.
Well, John, thank you so much. And hi, everybody from sunny, breezy Washington, D.C. It's a lovely day here in the nation's capital. As John said, my name is Mike Townsend, and I am part of a little team here at Charles Schwab that has an office in downtown Washington. There are 5 of us, and it's our job to watch what's going on Capitol Hill, in the halls of Congress, at the White House, at the regulatory agencies like the SEC and the Federal Reserve, and really just figure out what it all means for individual investors. And I spend a lot of my time doing this. Normally, in normal times, I'd be traveling all over the country, and I'd probably be visiting you in person, but doing a lot of these kind of Zoom calls to talk to investors all over the country about what's happening in Washington. I try to think of my job as helping you cut through all the noise and the nonsense that comes out of Washington and figure out what's really worth paying attention to. So that's what I'm going to do today. I'm going to walk through some slides that kind of go through the current political environment, what the key issues that we're watching are, and some of the things that we think over the next few months have the potential to affect the markets and investors. So before I get into the kind of Washington politics, I thought I would start with just a couple of kind of fun slides that sort of take an overview of the world in which we're living right now. And I'll start with this first one, which looks at the use of public transit in cities around the world from right before the pandemic started to just this week. And what I think is interesting, this basically is subway ridership in major cities. And what I think is interesting is obviously you see the sort of cliff in March of 2020 where countries and cities around the world shut down, people started working from home. But you look at the kind of fits and starts where it's come back in different places and in different ways over the last year or so, and see how in most places we're still way below that line across the top. And that line is sort of your average pre-pandemic use of subways. And one of these squiggly lines down at the bottom is my city of Washington, D.C. And we are nowhere near fully reopened at this point. Most federal employees are still working remotely, so there are not many people downtown. We don't have anywhere near the tourism that we normally would have this time of year. Spring is our big tourism time. And it's really, really quiet here in Washington. Great for my commute. There's not much traffic. Great for parking if you do come downtown. But not so great, obviously, for all the little businesses that depend on federal workers, that depend on tourists, all the lunch spots and that sort of thing. So still very quiet. Washington metro system is operating at somewhere between 50 to 60% below what would be normal capacity this time of year. This next one is another way of looking at kind of the same thought. This is the use of TSA screening checkpoints at US airports. The light blue line at the top is 2019. The darker blue line is 2020. And the red line coming in from one side there, that's 2021. And you see that in 2021, we've now sort of crossed where we were, and we're now above where we were really at any time in 2020 after the pandemic started. but we're still way below 50% below where we were in 2019 in normal times. So it's still a long, long way to go to get air travel back to normal capacity. And then finally, another way to look at it, this is the use of the Open Table restaurant reservation app, where you can make a reservation at a restaurant on your phone. And again, went absolutely down to zero as most cities were closed and restaurants shut down. But then this is different US states, and you see how it's kind of come back in fits and starts again, and at different paces depending where you are in the country. But in most places around the country, still way below what would be normal restaurant attendance capacity. So you take those slides and then you compare it with this, which is the 12-month S&P 500 performance. And obviously, we're now more than a year past the low point of the market on March 23rd of 2020, and you see a fairly steady upward line. There are a few little dips and that sort of thing. But I think this causes a real disconnect for the average investor, where, for an investor looking at their own life and thinking, I'm not really going to restaurants, I'm not traveling like I used to. In a lot of cases, my kids are down the hall, still doing remote school, at least a couple days a week, that sort of thing. And yet you look at how the market has increased 50+% over the last year. And it's resulted in some investors sort of missing out on opportunities they could have had, in part because they sort of weren't watching the market at the same time as they were kind of watching the state of their own life, if you know what I mean. So I just show those because I think they're really interesting visuals, and I wanted to kind of start with that sort of 50,000 foot look. Now, though, I'll jump into what's going on here in Washington. And in Washington, it's often said that personnel is policy, meaning the people who are in key positions really tell you a lot about what the policies are likely to be out of the administration. And so I wanted to note 4 names that every investor should know over the next couple of years. And I'll start with the most obvious one, Janet Yellen, the former Fed chair, now Treasury Secretary, first woman to be the Treasury Secretary in the 231-year history of that department. And I think we're seeing very early on that she is kind of one of the faces of the economic recovery. She's taken a pretty public role. She's testified on Capitol Hill a few times. She's doing news conferences. She's doing speeches. I think she's going to be a very visible presence, particularly over the next year as the economy continues to accelerate. The other thing I think is important, of course, is that because of her long history at the Fed and her close personal relationship with Jerome Powell, the current Fed chair, I think you're going to find real close ties between the Treasury and the Fed sort of strategically going forward. So particularly at the end of the Trump administration in late 2020, we saw some sort of breaking of the connection between the Treasury Department and the Fed. They were sort of at odds in certain strategies. I don't think we're going to see that during this administration. I think Yellen and Powell definitely sort of in lockstep in their messaging about the economy. Second name to know, Marty Walsh, who just started as the Labor Secretary, former mayor of Boston, Massachusetts, former union head. His experience is mostly on the what I call the traditional labor side. So, workplace safety, minimum wage, pay equity, all that kind of thing. But the reason he's on this list, and he's important for investors to know, is because the Labor Department, part of their jurisdiction is employer-sponsored retirement plans, 401k plans. And so he's going to have regulatory authority over those plans. And I expect you'll see him make some changes in that area. We don't know kind of where those necessarily will be. And I think you'll see an effort out of the Labor Department to strengthen employer-sponsored plans, particularly for smaller businesses that maybe haven't had an opportunity yet to start a plan for their employees. So he's going to be someone that I'm going to keep my eye on over the next couple of years. The individual who's likely to have the most direct impact on the markets and on investors over the next 4 years, no question, is the brand new SEC Chairman, Gary Gensler. Confirmed last week, sworn in office on Saturday. This is his first week on the job. He is a known quantity here in Washington. He worked in the Treasury Department under the Clinton administration. He worked as the chair of the Commodity Futures Trading Commission under President Obama. And when he was there, he got a real reputation as a very tough enforcer, someone who was particularly tough on Wall Street, did not sort of bow down to the Wall Street powers that be. And I expect that he's going to have that same role at the SEC. I'm going to talk in a couple minutes in more detail about what we think is on the SEC agenda, but I expect that he's going to focus on things like improving disclosure by public companies, shareholder rights, increasing shareholder rights, executive compensation, making that more transparent, those sorts of things. And as I said, I'll come back in just a minute to what else we think is on their agenda at the SEC. And then the last name to know, Rohit Chopra is the president's nominee, not yet confirmed, for the Consumer Financial Protection Bureau, which is the agency that was created in the wake of the 2008-2009 financial crisis. It started in 2011, and it has jurisdiction over what I call sort of the everyday financial products. So mortgages, credit cards, auto loans, student loans, those types of things. It's an agency that Republicans are not big fans of, and so it was kind of sidelined during the Trump administration. I think you'll see it in a much more prominent role, particularly in the student loan area. Rohit Chopra is a student loan expert, and so he's been named to head this agency. And once he gets confirmed, I expect they'll focus on student loans in particular at that agency. So those are some key names to know. Over on Capitol Hill, one of the pieces of the 2020 election that didn't get a lot of attention was the fact that Democrats lost seats in their majority in the House of Representatives. And you see here that they had a fairly significant majority in the last Congress, but in this Congress, right now, it's 218 for Democrats, 212 Republicans, and there are 5 vacancies due to death or resignation. Those 5 vacancies will be filled by special elections later this year. But that's a really narrow majority. For the Democrats, it's the narrowest majority they've had since 1877. So what that means for Nancy Pelosi as the Speaker of the House is that she's got extraordinarily narrow amount of wiggle room when it comes to kind of wrangling everyone on the Democratic side together and getting them to vote for a bill. The margin right now, think of it as 3 votes, because if 4 Democrats oppose Nancy Pelosi on a bill, and all the Republicans stay aligned, then that bill would go down to defeat. And what that means is that relatively small groups of Democrats have kind of outsized power, because whether it's a small group of progressives on the left or maybe moderates more towards the center, they can band together and go to Nancy Pelosi and say, we have issues with this. We're not going to support it unless you make these changes. And that's a lot of leverage to hold in Washington. One other fun fact about the House of Representatives, all-time record 118 women in the House this year. But I think really on Capitol Hill, most of the attention is on the fact that we have a 50-50 Senate, a relatively rare occurrence. And the Constitution says that the Vice President of the United States, Kamala Harris, gets to break ties in the Senate. So that gives the Democrats the narrowest possible majority that they can have. Vice presidents have actually broken more than 250 ties on different votes, going all the way back to John Adams, who, as the very first vice president in 1789, cast the first tie-breaking vote. Interestingly, Mike Pence, who just finished up as vice president over the last 4 years, broke 13 tie votes during his 4 years, which is actually the most by any vice president since the 1800s. But what it means is that incredibly small majority, I mean, it's barely a majority, is going to be really tricky to navigate. So think of what I just said a moment ago about how tricky the House is going to be to navigate with a narrow majority. This is that on steroids. Really, really difficult to get them all on the same page. And when you think about the Democrats in the Senate, you've got this very wide ideological spectrum, ranging from Bernie Sanders and Elizabeth Warren on the progressive side to moderates to conservatives who represent red states, like Senator Joe Manchin of West Virginia, Senator John Tester of Montana. So getting all 50 Democrats on board, and you've got to have all 50 in order to have that tie-breaking vote come into play. Getting them all on board something is not going to be easy this year. And the result of that is it probably curbs the Biden administration's most ambitious goals. They're going to have to kind of maybe step back and make sure that they have common ground within the wide range of views in the Democratic Party. One thing that a lot of people talk about, and you've heard a lot about over the last few months, is whether Democrats will vote to change the Senate rules and eliminate the filibuster. And at this point, that looks really unlikely. There are at least 2 senators, Joe Manchin from West Virginia and Kyrsten Sinema from Arizona, who have publicly said that they are opposed to eliminating the filibuster. And in fact, Joe Manchin wrote a op-ed piece in the Washington Post a couple of weeks ago, and the headline was, "I will not vote to eliminate the filibuster," which seems to make his viewpoint pretty clear. What that means is that you're not going to see all of these big kind of structural changes that that you've heard about, adding a 51st state like DC or Puerto Rico. In fact, the House of Representatives passed today a bill that would give DC statehood that really is not likely to go anywhere in the Senate. You're not going to see something like, packing or changing the size of the Supreme Court. I think all those kinds of big ideas are off the table unless something dramatically changes with regard to the filibuster. The other important thing to know about a 50-50 Senate is that there's this process in the Senate called budget reconciliation, and it's a special set of rules where you can pass a piece of legislation without having it be filibustered and with only a simple majority needed to pass. Because of the filibuster being in place, it usually means that you need a supermajority of 60 votes to end the filibuster and move forward and pass a bill. But under these special set of rules, you don't have to do that. You can just have 51 votes. Normally, it's only available once per year as part of the annual budget process. However, in a quirk of pandemic times, Congress actually didn't ever pass the budget last year. So that means that as this year started, they were able to use the current budget that they're in, which was never passed, as one vehicle to use this special set of rules. And they did so on the economic stimulus bill that passed last month. Now, of course, they're considering the next year's budget, 2022 budget, and that process affords them a second opportunity to use these special rules. That's where you're hearing about things like infrastructure and other possibilities under that bill, under those rules. There are strict limits on what can go in that kind of special rules package, and mostly everything has to relate either directly to government spending or to government revenue. We saw this play out in the stimulus bill. The House stimulus bill originally included a provision to raise the federal minimum wage to $15 per hour. That was ruled out of order by the Senate parliamentarian, that it didn't fit in this special structure. And so that got left out of the economic stimulus bill as a result. So with that, where are we now? As you probably know, in the last couple of weeks, the White House has unveiled its next big initiative, which is an infrastructure package of about $2.25 trillion. You see here some of the key provisions, a lot of money for roads and bridges, what most people would call kind of traditional infrastructure, money for affordable housing, for schools, veterans hospitals, federal buildings, then a lot of money for electric vehicles, for the electrical grid, for broadband expansion, and other things for climate change. There's a lot of money for long-term care and elder care, kind of expanding the definition of what constitutes infrastructure. That bill was proposed to be paid for with a corporate tax rate increase to 28%. Corporate tax rate was lowered to 21% in 2017. This would bring it to 28% under the White House proposal. Here's what's really important to understand, though. The White House proposal is like a 20-page bullet document. It's not a piece of legislation. Congress is going to have to turn this into a bill. And making things even more complicated, the White House is about to unveil the second part of their sort of what they call the Build Back Better plan. That's this second bill that's kind of focused on more social services side, childcare, universal pre-kindergarten, paid leave, that sort of thing. That bill is about to come out. So Congress is going to have to take these two gigantic ideas and figure out how to turn it into actual legislation. And once that happens, it's going to change a lot. There are a lot of cooks at that kettle, and it's going to take a long time. It's going to take months and months. The White House wants to see all this passed by late summer. I think that's ambitious. I think the fall is a more realistic timeline. So it's going to take a while to write the bill, and it's going to take a while to get it through Congress, if it can even get through Congress. And one of the reasons it's not clear that it can get through Congress is because it has tax increases in it. So that's probably the #1 issue on the mind of investors. So let's talk about that in a little bit of depth. No question, tax increases are in play, given the configuration of Congress and the White House. Couple things to keep in mind. It is extremely unlikely that any tax code changes that happen this year will be retroactive to the beginning of 2021. Really important point to make. There's been a lot of concern about this, but there is basically no one talking in Washington about them being retroactive. Everything is forward-looking, effective January 1 of 2022, that sort of thing. Even Janet Yellen recently said that she was thinking that any tax increases would be forward-looking. So what that means is that there's going to be time to understand, to digest what, if any, changes are passed, consider how they affect your situation, talk to your financial advisor, talk to your tax advisor, and figure out what, if anything, you might want to do strategically in advance of any tax increases. And again, there's no guarantee that there are going to be any tax increases that can pass Congress, but the momentum seems to be heading that way. I just think it's really important to understand. I think it's extremely unlikely that they would be retroactive. Also, the other thing to know is that there isn't going to be a tax increase bill with all these things in it. These tax increase proposals are going to be attached to the spending proposals. So what we saw with the infrastructure was a corporate tax rate increase. What we're going to see in this next bill on child care and elder care and those sorts of issues is likely to be some individual tax increases, but they're going to be sort of plucked out and attached to these different bills. So what are we talking about? Well, the way I think about individual taxes in particular, I kind of put them in three separate buckets based on sort of political achievability. And in the first bucket, the bucket that has the broadest Democratic consensus, and therefore I think is the most likely to happen, is some sort of increase in the corporate rate. The president has called for 28%, but some key Democrats in the Senate would like it to be maybe a little lower, 25, 26%, something in that area. So that could wiggle a little bit. And taking that top individual rate back to 39.6%. The top individual rate went down to 37% in 2017 as part of the Trump tax cut bill. This would take it back to 39.6. And in fact, just this afternoon, the New York Times and other media outlets did report that, in fact, the increase to 39.6% will be part of this next proposal that is coming out that I mentioned on childcare and elder care and those sorts of issues. So I think that's the one that's probably the most likely to happen. In the next bucket, harder, definitely in the mix, but not yet having everybody on board, are things like changes to the estate tax, changes to capital gains and dividends, possibly a financial transaction tax, and then the state and local tax deduction. And let me talk about each of these for just a moment. On the estate tax, during the presidential campaign, Joe Biden talked about lowering the exemption amount and also ending the step up in basis. Ending the step up in basis is really controversial. And it's not clear that you could get sort of Democratic unanimity behind that. Lowering the exemption amount seems like an easier one. Democrats generally want to target any tax increases that they have on wealthier filers. That would kind of meet that test. On the capital gains and dividends, similarly, the president during the campaign proposed taxing capital gains as ordinary income only for filers making $1 million a year or more. So that would take, if the individual rate goes all the way up to 39.6, you could see as high a rate as 39.6 on capital gains and dividends. That number could also move. There are some on Capitol Hill who are talking, well, maybe they shouldn't be taxed as ordinary income, but maybe we take the rate up to 28% or 30% or something like that. Maybe that $1 million income level changes a little bit. There are a lot of pieces of this that could change. So this is far from a done deal at this point. A financial transaction tax is an interesting one. Financial transaction tax has been around Washington for a decade or more. Financial transaction tax exists in some European countries. There's the equivalent of a financial transaction tax in Hong Kong, but it's never really gotten a ton of momentum here in the US. The reason it's got a little more momentum in 2021 is the fact that The whole sort of GameStop crazy trading that happened earlier this year, where these kind of meme stocks got all talked about on various chat boards and that sort of thing. And GameStop Corporation and others went on these crazy rides in January and February. Well, some on Capitol Hill think, one of the ways to kind of curb the really speculative kind of trading is to impose a small tax on all stock and bond and derivatives transactions. That's a financial transaction tax. Specifically, a bill has been introduced in the Senate to impose a 0.1% tax. That would be the tax. Like I said, it has not generally historically gotten strong backing here in Washington. It's gotten maybe some more momentum this year, but I still think it's kind of a long shot to actually happen. And then one of the interesting fights is over the state and local tax deduction, the so-called SALT deduction, which was capped at $10,000 as part of the 2017 tax bill. That's something that sort of disproportionately affects people in a handful of states: California, New York, New Jersey, Illinois, and Massachusetts. So the members of the congressional delegations in those states really, really want to see that changed. But the reality is that most representatives that represent other parts of the country, this isn't a big priority for them because it doesn't really affect their constituents that much. So this is going to be an interesting one to watch because it does have some powerful backers in making some changes, and yet it doesn't have kind of broad appeal. And also because it sort of acts as a tax cut for if you take that cap up, that's a tax benefit for the wealthiest filers. And that kind of goes against the White House's kind of goals to target tax increases on those filers. So that one's a very murky one. Final bucket, the bucket that I think is really, really hard at this point, are things like a wealth tax. Elizabeth Warren and Bernie Sanders have a wealth tax proposal that would impose a 2% tax on assets over $50 million, and then an additional 1% surtax on billionaires. It hasn't gotten a lot of support. And part of it is that it's really complex to administer. How do you value hard to value things like art or something like that? How do you enforce it? That's going to be, that would be very difficult. So right now, I think that's a pretty unlikely outcome. Similarly, there have been some proposals to tax unrealized gains on an annual basis, but similar implementation and enforcement problems, the sort of structure of it would be really complex for taxpayers. So it hasn't gotten a lot of momentum. So those three buckets are kind of how I look at the sort of universe of possible tax increases. I think there's a chance that something happens later this year, but I think we'll have notice about it, and I think it won't go into effect until 2022. And it's not a slam dunk that it happens, given the complex and very, very thin margins in Congress. Another issue that people ask me a lot about is how all the spending that has been going on. Congress has spent about $5 trillion in the last year on economic stimulus and coronavirus response packages. And that has really increased the federal deficit. Projected deficit is around $2.3 trillion, even before the March stimulus bill. As a percentage of GDP, that's the highest since the end of World War II. It's brought our national debt to $28 trillion, which is now more than 100% of GDP. So really staggering numbers. The way that this is going to kind of come into play here in 2021 is that Congress is required to set a limit on the amount of debt that the United States can accumulate. And that's known as the debt ceiling or the debt limit. The debt ceiling was suspended by Congress 2 years ago in 2019, and it comes back in that suspension ends on July 31st. So on August 1st, we'll have a debt ceiling. And by the way the law is written, we will be at that debt ceiling at that time. What happens then is that the Treasury Department can sort of move paper around kind of temporarily and make sure that we don't default on our debts for a while, usually a few months. But at some point this fall, Congress is going to have a vote to raise or suspend the debt ceiling again in order to avoid the United States defaulting on its debts. The US has never done so in its history. We have come close a few times. And when we've gotten very close, when Congress has put us right up at the edge of defaulting, the market has been very volatile historically. The market does not like getting close to that default deadline. So it's something to watch later this year because we're not sure how Congress is going to respond to this. You know, it's a lot of political sort of posturing and bickering. At the end of the day, you know, Congress never has, and I don't think will let us default. And I do think that the debt ceiling will ultimately get raised, and we won't have that problem. But it'll be kind of tense getting there, and so it's just something to keep an eye on as we head towards the back half of the year. A couple of other issues to watch. I mentioned the whole sort of GameStop Reddit retail trading frenzy that happened earlier this year. It's gotten a lot of scrutiny here in Washington, both on Capitol Hill, where there have been 3 hearings about it in Congress, and also at the SEC. And ultimately, I think it's going to be the SEC's responsibility to look at this. Congress does not really want to legislate in this area. So they'll hand it off to the SEC. The SEC has already undertaken a study to kind of look at what's happened. And the question is, you know, will more regulation be needed? And some of the areas that they're looking at, probably at the top of the list, is this idea that what people are referring to as the gamification of stock trading, meaning that it's become so easy on your phone, like it's like a game to trade stocks. And, you know, there are a lot of investors who are maybe making riskier, more complex trades on their phone that they don't even really understand. That's the worry, at least. And so there's a lot of questions about whether there needs to be more disclosure, education for those kinds of investments. Also looking at the role of short sellers and hedge funds in the market. And then kind of what are the conflicts inside the market plumbing? Really, what happens when you push trade on your computer or your phone and it disappears and it comes back to you and says it's done? Where are the conflicts in there? Where is money being exchanged in that process? There's something called payment for order flow, which is where there is money exchange for having certain entities execute that trade as opposed to others. It's a complicated process inside that plumbing, and there's a lot of scrutiny on that to make sure that that's working out in the best way possible for ordinary investors. So that's something that we're going to be watching. The thing is, the regulatory process is really slow. The way to think about this is that the SEC is taking a look and producing a study on this. I expect that once they produce that study, there'll be a comment period to review and the public can look at that study. Then there'll be these comments and the SEC will look at the comments and they'll decide whether they should put forward a regulatory proposal, and then they'll put that out and there'll be more comments. And it's just a clunky process that takes probably a year or more before we'll know what kinds of changes. So nothing happening anytime soon, but definitely something that's going to be occupying a lot of energy here in Washington this year. A couple of other issues I wanted to mention. There has been a lot of scrutiny, and it seems like it goes up every day, on the big tech companies here in Washington. And that's both sort of traditional big tech companies, but definitely the social media companies in particular. We've seen just in the last several months, we've seen the US Department of Justice charge Google for anti-competitive behavior in its ad and search businesses. We've seen House Democrats release the results of a 16-month antitrust investigation into Amazon, Apple, Facebook, and Google, and basically conclude that I think the quote was, these companies need to be reined in. Now, what they didn't conclude was exactly how they would rein in these companies. And that's kind of the place that we are now, sort of this big debate in Washington about what could or should be done about these companies. You not only have the antitrust issues, you've got data protection, data security, privacy issues, and particularly for the social media companies, you've got misinformation, disinformation. How are they sort of monitoring information, particularly around things like the election, around things like the vaccines and that sort of thing. So just a couple of weeks ago, at the end of March, there was a very testy hearing on Capitol Hill with the CEOs of Facebook, Google, and Twitter about these kinds of content management issues. There's just a sort of bipartisan frustration with these companies. What that's actually going to look like is what is not as clear. And when you think we haven't used the antitrust laws in this country to break up a company since AT&T in the 1980s, it seems unlikely that we're headed that direction. So from an investor standpoint, I tell investors, just keep an eye on all of this. I don't think we're at the point where you need to start thinking about making changes to your portfolio, but we all know how important these companies are to the markets. We know how many investors are invested in them, either directly or indirectly through mutual funds or exchange traded funds or retirement accounts, that sort of thing. So it's something for investors to watch, but I don't think it requires action right now. Most of the risk is, at the moment, I think for these companies, is kind of headline PR, a media risk, as opposed to, huge structural risk. But at some point, we may get a clearer sign of what the government might do to try to rein in some of these companies. And then finally, there is a lot of interest here in Washington in a retirement savings bill. At the end of last year, late 2020, there was a bipartisan bill introduced that was notable for how broad the bipartisan support for it was. It ended up not moving before the end of the year. And because that's the end of that Congress and the new Congress started in 2021, the whole process has to start over and that bill needs to be reintroduced. But the authors of it have said they're going to reintroduce it this spring. And the key elements include raising the required minimum distribution age to 75 from the current level of 72. It would also add a second catch-up contribution. So today, when you turn 50, you can start contributing more to your retirement accounts, known as catch-up contribution. This would add a second step up at age 60. There would be some incentives for lower income savers. There would be incentives for small businesses to start plans, those kinds of provisions. It would increase the amount that you could roll from an IRA directly to a charity. So these are all provisions that were in last year's bill that we expect to be in the new bill that's going to be reintroduced this spring. And because it has broad bipartisan support in a time in which there's not broad bipartisan support for a lot of things here in Washington, we do think it has a chance to move. We don't know where it is on the priority list. It's probably kind of lower on the priority list, which probably pushes it off to the end of 2021, maybe even into early 2022. But we think there's some good provisions in this bill, and so it's something that we'll be monitoring. As we look ahead in Washington, it's always said that once one election is over, the next one has already started. That's definitely true this time. The midterm elections are in 2022, and midterm elections historically are terrible for the president's party. You see here that since the Civil War, the president's party has lost seats in the House of Representatives in 37 out of 40 midterm elections, and the average loss is more than 30 seats. When you think about what I said earlier, this is a single-digit majority for Democrats in the House. That's a big risk there for Democrats and the future of their majority in the House. Similarly, in the Senate, not quite as dramatic, but the average loss for the incumbent party has been 3 to 4 seats. Of course, we're in an environment right now where it's a 50-50 tie, so every seat could potentially swing control of the Senate. As we look at the Senate in 2022, 20 Republican Senate seats are up for re-election, 14 Democrat seats. 5 of those 20 Republicans have already announced that they're not running for re-election. So there are going to be a lot of open seats in 2022. And in presidential elections, we always hear about the swing states, the battleground states. You'll hear about them in the midterm election because the 6 states that were the closest in the presidential race in 2020 all have Senate seats on the ballot: Arizona, Georgia, Nevada, North Carolina, Pennsylvania, and Wisconsin. So you're going to hear about these battleground states as we head into the midterm elections, because those states are going to determine which party controls the Senate. So before I take your questions, I just want to end with a couple of visuals that sort of try to connect the dots between what happens in Washington and what happens on Wall Street. And I think this one is really interesting. We went back 120 years to look at how the market behaves during different configurations of the political dynamics in Washington. And the one we have right now is the most common over the last 120 years, which is an all Democratic Washington. Democrat in the White House, Democrats controlling the House and Senate. But the second most common is the opposite, all Republican Washington. And you see there in that red circle how the market has performed. It's essentially identical under both scenarios. And what I think that says is that it's easy to overestimate how much influence the political situation in Washington really has on the markets. The markets generally don't care that much about who's in power. So another way to look at it, if you had invested a dollar back in 1961, this looks at the growth of that dollar based on whether a Republican was in the White House or a Democrat was in the White House. And you see fairly steady climbs. And the dips that you see are sort of outside events, right? 9/11, the financial crisis of 08, 09, the bursting of the tech bubble in the early 2000s, not really dependent on who was in the White House. Exact same chart, just based on who was in control of Congress, with, of course, red being Republican, blue being Democrats. But more often than not, we have a split Congress, and that's the purple sections. So again, not a lot of correlation between market performance and who's in Washington. And this is probably the best way to look at it. If you had invested $10,000 in 1900 and only kept it in the market when a Republican was president, well, you'd have $98,000 today. If you only kept in the market when a Democrat was president, you'd have about $430,000 today. But of course, if you kept it in the market the whole time, no matter who was in the White House, you'd have $4.2 million today. So it's always said, I'm sure your advisors at Red Door have told you before, it's never about timing the market, it's about time in the market. And I think this is a really good illustration of that, especially coming out of the volatile election year that we just had. It can be really easy to kind of overreact to what's going on in Washington from an investing standpoint. The correlations just aren't really there. The market cares about corporate earnings. The market cares about what the economy is doing. And yes, when you think about if this infrastructure bill passes Congress, that there definitely are going to be market implications. There are going to be parts of the market that are going to be really happy about that, and parts of the market that maybe aren't as happy. But overall and over time, the correlation between what happens in Washington and the market is pretty thin. So while John queues up the questions, I'll just let you know how you can keep track of what I'm talking about. You can follow me on Twitter at Mike Townsend CS. You can also listen to my podcast, which John mentioned. Washington Wise Investor is what it's called. You can find it on any podcast app, Apple or Spotify, whatever you like. Comes out every other week. The new one just dropped this morning, and in the new one that dropped this morning, I actually answer the 7 most commonly asked questions that I've been getting over the last 6 months. So some of them you heard a little bit about, but I think you'll find it interesting. You can also just go to schwab.com/WashingtonWise. You don't have to log in. You don't have to give us any information. It's just there for anyone to listen to right on their computer. So check that out when you have a minute. With that, I'll show a few disclosures, and then John, I'll bring you back in to see if there are any questions. Thanks so much.
Perfect. Well, thank you, Mike. That was some great stuff, and we appreciate it. And I can attest to Mike's podcast. I'm a listener, and so I highly recommend you going out there and pulling some down. I think you'll enjoy it. As a reminder, you can send in questions in the Q&A box below. I've got a couple here, Mike, pulled together already for you, but feel free to shoot them in, and I'll relay them to Mike. So first question, Mike, given the possibility of significant infrastructure spending, which sectors do you think present investing opportunities?
Yeah, this is going to be interesting, because, again, what we have right now is kind of a general outline from the White House, and Congress is going to turn this into an actual bill. And when it comes to infrastructure, every member of Congress cares about infrastructure, because every member of Congress has roads and bridges and that sort of thing that need repairing. I think the broader question is sort of the White House version has a lot of climate change related stuff in the bill, and will Congress keep that and those elements? Because if they do, then I think that really could be a plus for some of the alternative energy areas, for things like electric vehicles and companies that make charging stations and that sort of thing could be really advantaged coming out of this bill. And then, of course, your sort of traditional industrials and materials sectors in particular, companies that make big earth-moving machines likely to do well on this. Companies that make the materials that you build roads and buildings and bridges with, are likely to do well. So traditionally, industrials and materials are kind of the ones to watch. The one I'm most curious about, though, of course, is energy, and exactly how much sort of tilt towards alternative energy side ends up in the final package, I think is going to be key to watch. And keep in mind that even when I say there's going to be a tilt towards alternative energy, we're not talking about a abandonment of traditional energy. I think there's going to be a balance, and that this is an opportunity to have balance in your portfolio in that sector.
Great. You mentioned obviously the growing debt and the budget deficit. So do you think that increases the risk of inflation?
Yeah, this is a big question that a lot of people are asking around inflation. There's definitely sort of this market sentiment right now that inflation is a growing risk. And it's been interesting because you look at Fed Chair Jerome Powell, who keeps saying everywhere he goes, we're not worried about inflation. We're not worried in the short term about inflation. And some of the concern about inflation is a little bit artificial right now because you're comparing, say, year over year prices. Well, comparing the prices in April 2020, when everything was locked down and we were at the front end of the pandemic, you can see how there's a little bit of artificiality there. So, there could be some kind of bump in inflation here in the short term, but the Fed has really said pretty clearly they don't think it's a big worry. They think any bump is going to be temporary and very easily controlled. Longer term, out 2, 3, 4, 5 years, I think the worries start to get bigger, and the federal deficit definitely contributes to that, and the potential for interest rates rising, after a few years, and that sort of thing. It's going to be there's a lot of pieces to watch here, obviously, but our view is that we're not worried about it in the short term, but we start to focus on it more 3, 4 years out down the road.
Well, piggybacking off that, so here's a question for you. It seems like there are fewer and fewer people in Washington who really care about the deficits anymore. So how do you think Congress digs out of the deficit hole?
Yeah, that's a really interesting one. The reality is, I like to say, when I started my career as a Senate staffer back in the early 1990s, the national debt was less than $5 trillion. And at that time, everyone, as it started to grow, everyone was like, oh, it'll never get to 10. We'll have to do something about it by then, and 12, 15. And actually, what's interesting is that the larger the number has gotten, actually, there's like an inverse relationship between how much people are concerned about it. Because I think part of that is $28 trillion of debt is like a meaningless number to the ordinary person. Most people can't say why that matters to them. How does that affect my life? And as a result, that they don't put any pressure on Congress, right? They're not protesting on the Capitol steps about the debt right now. So I think that has, and kind of the longer you go without really seeing what the effect is, the sort of easier it is to ignore. The other thing, of course, is that getting the debt and the deficit under control requires choices that most politicians don't want to make. I mean, you've got to raise taxes, you've got to cut spending. You don't win a lot of points at home for raising taxes and cutting spending in government programs. So it's a real conundrum. And, I wish there was like a kind of a magic answer for it, but I don't know what it's going to take for these guys to make some of those tough choices.
Yeah, well, time will tell. Switching gears on you, so the U.S.-China relationship has a lot of implications for the markets. It seems like that relationship's at a low point. How do you think the Biden administration will approach the China relationship?
Yeah, I'll tell you that when investors ask me kind of what I worry about, I actually worry about the U.S.-China relationship as one of the real risks out there, because you think it was just over a year ago that the U.S.-China phase 1 trade deal was signed, just before the pandemic kind of really blew up. And at that time, that was kind of, wow, that was a big deal. That was a big negotiation. Well, think of what's happened since then. Not only the pandemic, but crackdown on Hong Kong. You've got tensions in Taiwan. You've got the treatment of the Uyghur people, the Muslim minority in Northwest China. You've got still trade and tech and IP disputes with China. Things are not in a good place. And Biden so far has been pretty kind of low key about it. He did talk to Chinese President Xi Jinping in February. There's no plans right now for them to have some kind of summit. Xi Jinping did agree to join the call that the president has put together this week for Earth Day on climate issues. So I think that's a good sign. But I just really feel like the relationship is at a real low point. And given how important China is to emerging markets investing, to currency investing, to commodities investing, it just feels like there's a lot of risk there. And the point of biggest risk for me is the rising tensions over Taiwan and the potential for some kind of military, action by China towards Taiwan, then putting the U.S. in a situation which we've got to decide whether to get involved in. That's kind of my big sort of hard to pin down fear that the market would really not look on that favorably. We could be a long way from something like that happening, but I think it is a risk out there.
Well, this kind of is along the same lines, but what do you think the outlook for emerging markets is, and what are the factors that are most likely to affect that outlook?
Yeah, I think whenever you're kind of looking at emerging markets, investors tend to kind of look, at things like tensions in China and things like, the buildup of Russian forces on the Ukraine border and things like Iran, interest in their nuclear program and that sort of thing. So you look at these kind of hot spots of risk, and that's where I think emerging markets investors tend to get sort of antsy around what happens if that happens, what happens if this happens, and that sort of thing. But I think right now, without those kind of mysterious X factors out there, to me, the biggest thing, to watch from emerging markets is vaccine distribution and how quickly that, kind of gets out there to different parts of the world. We're seeing pretty startling numbers right now come out of India. And that's a real worry that, India's pandemic numbers are going up and their COVID-19 numbers are skyrocketing, and that could spark another wave and be potentially risky for emerging markets. So I think the vaccine distribution to all these different countries is going to be one of the key factors to watch over the next short term. I would say 3 to 6 months.
Yeah. So you touched a little bit earlier on potential of getting different tax changes through, specifically on the estate and gift tax exemptions. What are you hearing? And not that you have a crystal ball, but where do you think that'll ultimately fall?
Yeah, I mean, if I had to guess on the estate tax, it seems, given the majorities in Congress, you could bring that number down pretty significantly. Would it go all the way back to say 3.5 million, which it was in the Obama administration? Maybe, but I'd say, it's more likely to go to 5 or something like that. And again, I don't have any specific insight into that. I'm just saying, kind of, when you think about it logically, you think, you could see that number. It sort of fits in the overall, we want to target tax increases to the wealthiest filers. I think the perception would be that would sort of fit that bill and probably not be that controversial within the Democratic Party. So I could see that happening. As I said in my comments a few minutes ago, the idea of changing the step up in basis, eliminating the step up in basis that's a huge fundamental rule change, right? That kind of changing the rules in the middle of the game. It's one thing to kind of mess with the numbers. I think people understand that that's a possibility. But to me, something like getting rid of the step up in basis would be a harder lift in Congress, just because it would be such a major sort of structural change to the way that the way that taxes have worked for a long time. So I think it's more likely, not definite, but more likely that they take that number down on the exemption level.
Gotcha. All right, looks like we got two more questions, and you kind of touched on this one a little bit earlier with Gary Gensler being at the SEC and mentioned disclosure. So this question is, with increasing interest in ESG investing from next-gen investors, with recent events catalyzing specific focus on social diversity and inclusion, what regulations do you believe will be rolled out to make information from public companies about environmental and social impact more readily available to investors?
Yeah, I actually think this is maybe one of the top priorities at the SEC for the incoming chairman. And in fact, even before he took office, the acting chair, who will remain as a commissioner, had launched a project to sort of review the existing public company disclosure requirements around climate change and other sort of ESG factors. Those haven't been updated since 2010. So I can almost guarantee that the SEC is going to require more disclosure in that area by public companies. Again, the process takes a while. So, yeah, I would think even if you got something sort of proposed and done this year, you're probably talking 2023 before, there's usually a year lead time for companies to kind of adapt to the change. So it's probably going to be a couple more years before you see the changes. But that's one place. And then just generally on sort of, putting some parameters around what is an ESG fund and what, that the investors really struggle with what's an ESG fund. The funds look, not pointing fingers at anybody, but they take a very expansive definition. They know it's kind of hot right now. And so I think you'll also see the SEC look at, can we standardize a little bit sort of what constitutes an ESG fund? It's going to be tricky, but I think they're going to take a look at it.
Gotcha. All right, last question here. Do you think the HR1 bill will get passed? And if so, do you think there will be any market implications?
Yeah, that's the voting rights bill. Tricky. It's passed the House. It's going to be really, really hard in the Senate. I think it could. You may have to change the rules possibly to get that done, the filibuster rule. And as I said, I don't know that that's likely. I don't think you're going to get any Republican support for it. So you would have to do it possibly under these special set of rules. But there's a lot of questions about whether that's possible. So there's a lot of impediments right now in the Senate. What I think is interesting on this is that you're seeing companies get sort of out in front on this issue anyway, right? You're seeing companies, you saw the situation in Georgia where you had companies reacting to a state legislative change, and not just sort of Georgia-based companies. Obviously, we saw Delta and Coca-Cola and but a lot of companies sort of looking at similar legislation around their states where they're headquartered or where they have big facilities and starting to get involved in this. And I think this is a really interesting trend to watch, because this is a delicate place for companies to be kind of weighing in on this stuff. And we've seen, obviously there's been some backlash to some of the companies that in Georgia, for example. So boy, this is a really fraught issue. And I think it has market impact to the degree that companies sort of get directly involved, frankly, in it. And we're gonna have to see how it all plays out.
Gotcha. Well, Mike, we really appreciate the time. We appreciate the insights, and to everyone still out there, I do recommend going out and listening to the podcast. It's very good. And thanks for taking some time and tuning in. As I mentioned earlier, this is recorded. So if you missed something, just shoot us an email and we can send it over to you. But thanks again, and everyone have a good rest of the day.
Thank you.